So what I wanted to start with first, and I gave you my PowerPoint that I kind of made out for you all. What I wanted to start off first, because it's probably like the most common question I have, is the differences between LLC, S-corps, corporations, and sole prop. I think probably this is like the #1 question I'm asked all the time, mainly because I do a lot of small businesses. And even if a person's an LLC, they still have no idea what kind of entity they are. I'll ask them, are you sole prop or are you S-corp? They're like, I'm an LLC. I'm like, no, that's not the question I asked. So people don't always understand that. And I think like sometimes if they're doing it through a lawyer or LegalZoom or whatever, it's not really cut and dry what you are. So LLC is really just for state purposes. So like only the state cares. No one else in the United States of America cares that you're an LLC except for the state of Texas, unless you incorporate in Delaware or some other state. But really it's for if someone sues you, you are basically legally protected. It's a legal protection, right? And I don't know how many of you all know that. And so the IRS doesn't really care about that, but they care is if you're a single member and you're filing as an LLC, then you're a sole prop. So nothing changes. So if you're a Schedule C and you're a sole prop from from before, and then you incorporate to an LLC, nothing really changes except maybe your name, right? Your business name. After filing the LLC docs with the state of Texas, I always encourage everyone to file an EIN. And that's where you'll say single member, you're a sole prop, you're multi-member, you're automatically a partnership. Now, unless you decide to classify yourself as something else, you are a sole prop as a single member, a partnership if you're a multi-member. If you decide to, you can incorporate and become a corporation or an S-corp. And kind of on the second page, I put how you would become an S-corp, basically using a 2553 and an 8832. They're really, really simple forms if you decided to do this, but I definitely would suggest coming to talk to me or another CPA to talk about the benefits and maybe just the thoughts. The benefits in S-corp, and I highly super recommend being an S-corp. Some people are a little, because they've gotten a lot of scrutiny over time, because what was happening is S-corps, they're not taxed with self-employment tax, so there was a lot of scrutiny during that time. I think it's kind of come over, and I think people, as long as they follow the rules of being an S-corp, they're good. But the benefits of an S-corp are they can be a single member S-corp, so you can only have one member. Like a partnership, you have to have multiple members. You yourself, you could be an S-corp by yourself, and it's less likely you're going to be audited by your S. I don't know how many people went to the talk that I went to on a tax panel probably a few months ago. I guess no one here, huh? But we had an IRS auditor, and he also was like, absolutely, well, he's the CPA now, but he's an IRS auditor. He used to be an IRS auditor. He's like, absolutely, S-corps are very little, seldomly audited. Sole props are audited so much more. I highly recommend being an S-corp if you make over the $30,000 mark, basically 20, 30,000. There could be some benefits to you. The net income of S-corps do not have self-employment tax, so that is negated, but you still have federal income tax, and it flows down to you as a K-1, so it's on your personal tax return as a K-1. And I have that, I have that information there. The disadvantage of an S-corp, and this is the biggest one, is that you have to be an employee of your own S-corp. And I have one person right here that's my client, and she's an employee of her own S-corporation. Sorry, Jackie, I put you on the spot. But, and she has a wonderful business name, Watercolor Moon, and she is an employee of her own S-corp. And I can't tell you, you save so much money doing it this way, unbelievably. But that it's one of the disadvantages that you have to basically process your own payroll, get a payroll service, do all those things, and there could be a lot of liability in it. So if you're going to do this way, you definitely need to talk to a CPA about it before you decide, let's do it, so you can see what the advantages and disadvantages are compared to you, because it also depends on the type of structure you are. Maybe it doesn't benefit you. And the S-corp has to file its own tax return too. So if you plan on doing everything yourself and file that own tax return, it's not an easy thing to do. So definitely, if you don't have a CPA, I don't know if I would tell you to do your S-corp return by yourself. It could be a little bit more interesting than a personal return. Any questions?
So my one question so far is, do you register an LLC and then just file taxes as an S-corp?
So what happens is you file as an LLC, and then you elect with the IRS. I think I have it in the beginning. You do an election with the IRS telling them, I want to be an S-corp. So you can still be an LLC with the state of Texas. You just file as an S-corp. Or if you know automatically that you want to be an S-corp, you can still file with the state as a corporation and then do the election for the S-corp. So there's several ways to go about it. Just depends on how you feel about it. Really, the LLC or the corporation is going to have that legal protection that you want. I always say to go to a lawyer anyways, but those documents are really, really easy to prepare, the LLC and the S-corp. Like I almost tell everyone, here is the document for the LLC and the corporation for the state of Texas. It's $300 to the state of Texas, and it's a super easy form. I mean, it's just your name, your address, your registered agent, that kind of thing. And the other thing is, I know a lot of registered agents charge like an annual fee, and most me and other CPAs, they'll be your registered agent for you as long as you're their client. So you don't have to pay anyone. It's basically your office address, their office address.
Quick question on that. What do you mean by electing so you are an LLC, and then you're electing S-corp for just for the
IRS. Yeah, either at tax time or before tax time. You just you're basically telling the IRS, because the IRS doesn't really care. Like you can be an LLC and the IRS doesn't really care. They'll just see you either, if you have one member, you're automatically sole proprietor. If you're multiple members, you're automatically a partnership. But if you do a separate election and tell them, wait a minute, I don't want to be either of those things, I want to be an S-corp, then they'll be like, okay, we'll let you be an S-corporation, and they'll allow that. Does that make sense?
Are you talking about transitioning to S-corp?
Yes.
Okay, I thought you meant like just for, okay.
Yeah, you have to do that election. You have to tell the IRS, this is what I'm doing. Otherwise, you're automatically a sole prop or a partnership. That's it.
Got it.
Does that make sense? So like for someone who's a sole prop already, and then you incorporate to an LLC, nothing changes with your tax return except adding that business name, blah, 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 LLC. That's like the only thing that changes. It doesn't help tax-wise. I think that's a big misnomer with that. People seem to think that maybe that'll help me tax-wise. It's really exactly the same. So where you want to take advantage of it is when you do an election for something now. Now, that being said, you can also do an election for a C-corp or just do a corporation. I wouldn't recommend it, but the only time I see people moving to C-corps, like an actual corporation, is when investors come around, and they're foreign investors. Foreign investors can't be partners in a partnership or partners in an S-corp, and so they have to be a C-corp. So they want to make money, they want to get dividends, so it benefits them to be a C-corp, so they'd rather do it that way. So, or a partnership, that's the other thing, that if they're not foreign and they're actual investors, and there's a lot of investors, some of them require that you're a partnership. So it just depends, like if you're going to get investors, that there would be different other venues, obviously, that would restrict these kind of differences, if that makes sense. But I mean, there are benefits to being a C-corp. It's completely separate from, I'm sorry, go ahead.
Yeah, if there are no tax benefits in being an LLC or an S-corp over being a sole prop or a partnership. Oh, okay.
There's benefits to being an S-corp over an LLC.
Yeah, but it seems like the main advantage of an LLC or an S-corp is the limited liability. Are there any tax advantages that you get from that over being a sole prop or a partnership?
I see what you're saying. So not necessarily, no. Okay. From being a sole prop and a partnership, you're still going to have the same taxability regardless. The only thing is that when you're an LLC or any kind of entity that's under the state of Texas, you're automatically granted some legal protection if you treat it correctly. So they call it like a corporate veil. If you're an LLC, we're going to talk legal terms here now. So you have this corporate veil around you once you incorporate with the state of Texas, whether it be an LLC or corporation, whatever. And from that moment on, anything in the business is protected. So if you got sued over something legally, if you got sued over writing or whatever, and they sue you for money, they can't take your personal assets. That is the difference between the LLC and the sole prop, really. So either way, I always say you should incorporate as an LLC regardless. If you decide to do an S-corp or a corporation or whatever you decide to do, you should definitely do some kind of LLC just to legally protect yourself. Then from there, you got to start separating, the assets of the business. Like treat it like a business, because it's got that corporate veil around you. You don't want to pierce that corporate veil.
I think maybe backing up for a second, explaining why somebody would be an S-corp.
Okay.
Because it didn't make any sense to me until you explained it to me. So
I'm very visual. I wish I would have I should have brought a drawing. So because as a sole prop or an LLC, you're going to have a Schedule C with your income and your expenses, and you're going to pay tax on that bottom line, right? And that's going to be on your personal return. There's a Schedule C that attaches to your personal return. Now that bottom line gets taxed at a federal income tax level, whatever your federal income tax level. It also gets taxed a self-employment tax of 15.2%. Okay, the S-corp negates that 15.2%. You're still gonna have to pay taxes on your net income federally, your federal income tax rate, but it takes off that 15.2%, and that number, let's say it's $30,000. You decide what that salary is. Let's say you got a salary, so your $10,000 would be, let's say, your salary. That's what you would pay self-employment taxes on. That's what you pay Medicare and Social Security tax on. So you basically just negated that amount of self-employment tax. Does that make sense? So that's the benefit of the S-corp.
And does it have to be a reasonable salary? I
It
mean,
has to be a reasonable
salary. So if
salary.
you're making $1 million a year, you can't
Right.
pay yourself $7,500.
No. So what happens is, I wrote that on there, that you have to pay yourself a reasonable salary, and I always say it's about 20% of net income.
Okay.
But it also depends on industry. So if it's a writing profession artist, the great thing is there's no reasonable salary for that. That could be really low, right?
Yeah.
For someone like an engineer, it's a little bit harder.
So as little as 20% though is fair.
Well, that's what our industry kind of. There's not any, like, IRS doesn't give any indicator of what's considered reasonable.
Okay.
Not to say that they won't in the future, because they might. But at the moment, they haven't given any amount what's reasonable, what percentage. So in our world, CPA world and tax attorneys, we all say 20%. I say we all. There's a few of us that literally throw that number out there, just from what we've seen. But I hesitate to actually say that. I can say that with you all, if all of y'all are artists and writers and that kind of thing. Different industries,
That kind of thing.
very well, because industries like engineers and software engineers, those averages are a little bit higher. So 20% might be too low. So there's still a benefit there, because you're still negating 80% of that, you know what I mean? Still, you're still going to negate a whole lot of that percentage of self-employment tax. And it's surprising how a small business can help them so much with that portion. Now, the other thing being said is that you lose Social Security benefits and Medicare benefits. I don't know how much of you all care about that, but that would be the other disadvantage of that. So you're not paying in as much in Social Security, you're not paying in as much in Medicare, so that's lower. So when you get your Social Security and Medicare statement, everybody always is like, whoa, it's low. I'm like, well, that's what we set your salary at. We set it low. But I mean, are we guaranteed it's going to
So
be there?
your Social
Not
Security
necessarily.
and your Medicare come out of that self-employment tax that
Yes,
you're into. Okay.
absolutely. So when they take it out of your tax return on your sole prop, Schedule C, it gets taken out of there, and they account for it. So when you incorporate an S-corp and you lower your salary on your W-2 wages, it's going to be a whole lot lower. So then you're going to notice a difference on your Social Security wages statement. Now, who knows how long that's going to be, but or continue to be, but that's the way it is. For a lot of people, I mean, I handle so many S-corps, and they don't care. They're like, it's way more beneficial at this point, tax-wise, to have that. Now, the other thing, and I'll kind of get into retirement, but retirement also comes into play when we talk about S-corps, because you kind of lose some credits if you do like a SEP. It's limited on a SEP. So the great thing about a SEP IRA is that you can do 25% of your net income on a sole prop, contribute that much, and be a deduction, or $53,000, whichever is lesser. So if 25% of your net income is $53,000, you can basically contribute that much, and it's basically a deduction. So that's the great thing about it. It's not dollar for dollar, but it's a deduction nonetheless, right? It lowers your adjusted gross income. So when you're an S-corp, it's 25% of your wages, but your gross wages on your W-2. So that could be lowered. So that's a big issue too. Like if you're going to contribute to SEP and you want it to be really high, then you may want to stay a sole prop. But that being said, if that number is high on your S-corp, on your Schedule C as a sole prop, there's very big chance you're going to get audited. I have one client that for years and years, I've been trying to convince him to become an S-corp. He's a perfect candidate. He makes just enough money. He's a perfect candidate to be an S-corp. He already has payroll. He pays people payroll. I'm like, you should make yourself an employee. And he hasn't, then he got audited. And now we're going through like 2 years of audits right now. And I'm like, ugh, we had just switched to an S-corp. This probably wouldn't be happening right now. But, that he's like, well, I should have listened to you. And now we're having to do this audit together. But go ahead, sorry.
What do you consider the amount you make? What is the threshold for you to switch
to S-corp? We're having that discussion. There's not really a threshold. It really just depends on what you're doing. So I kind of am in the interest of it. if it's 20 or 30,000 or higher and gross wages, I would say you might be a good candidate. If you have losses every year, not a good candidate just yet. It's basically if you're making money, then you might be a good candidate for an S-corp. Now, I do know some S-corps that have losses. That's the other thing. If you have continuous losses, and I have that in I have so many things that I want to talk about. They're all in here. If you have continuous losses as a Schedule C filer, as the sole prop, that could be red flag as a hobby loss. So whereas that's not an issue with an S-corp. You can continually have losses. I've seen many years of losses, and that doesn't get flagged as a hobby loss because that's a legit business with a balance sheet. I mean, there's a lot of things that go into an S-corp return. So they take that more seriously than a Schedule C because Schedule C is just gross wages, expenses, that's it. On a S-corp return, it's gross wages, expenses, then it's all this detailed asset list. It's got the balance sheet behind it. I mean, I don't think it's that difficult for a small business, but for someone else, it might be a little bit more difficult, but it requires a lot more information to the IRS. The IRS likes information, so they're not going to audit that as much. And if that line that says officer salary looks pretty decent, they're not going to bother you. Does that make sense? So, and if there's no number on officer salary, that's definitely a red flag.
I think maybe one of the differences might be helpful is if you're working at a full-time job somewhere and you're just publishing your first book or two, this is probably not, you're not ready for it. But if you're like me and Matt and a couple of the rest of us who are making their living as a writer in some capacity, maybe not entirely
Or
as
other
your novels,
freelance stuff,
right?
maybe.
Freelance stuff. So if you're a cover designer or anything else like that, and that's your job, and that's what you're doing, and your book income is maybe part of that,
Right.
then it makes a lot more sense.
Absolutely.
Thank you. That helps. Thank you.
Yeah, I think that, case by case scenario, it's funny because sometimes I don't use that number. Sometimes it's beneficial. I can just tell, like, let's say you have one employee. I'm like, oh my gosh, we just have to be an S-corp. I don't care if you have losses. Let's just do it right now because I feel like that's going to benefit you in the next couple of years. And it ends up being such a great opportunity and it works out. So it really just depends on the situations and things. Go ahead, sorry.
Well, I was just wondering, I have an LLC, but can you change it to the S-corp at any time?
I can change it on the tax return. Like, you can elect it when it's due. Like, literally you can make an election with the tax return on there. So you have 3 years. You can retroactively do it 3 years back, but I wouldn't do that if you haven't had payroll for yourself. Maybe I would, usually it's like at the end of the year, we decide, wait, we need to do S-corp here. And so we run one big old payroll and just pay the taxes, right? Just so there's a number there in officer salary. And then you know what I'm saying? So we usually do it at year end when we decide these kind of decisions. And for that specific year, 2016 in December, I'm probably going to make a few people S-corps in that same year. So.
And when you say run the payroll, is there do we actually kind of cut ourselves a check or something?
Well, so I
does this work?
I work a lot with ADP. I do have some paychecks reps that I like to outsource payroll just because there's a lot of liability in it. So I wouldn't suggest to do payroll on your own because there's quarterly reports, 941. There's a lot of little things.
So you don't just pay to me?
No. So what I do is I
$10
have
million.
at the end of the year, if I see that you made X amount of money, and I'm like, wait, let's just estimate what 20% of net income. We do an estimate, and let's say you should have had a salary of $10,000, let's say, and I just tell ADP, let's run a payroll for $10,000 as a manual check. You're like, I don't have $10,000 in the account. Okay, no big deal. We'll just run the amount of taxes of 15% of $10,000. Just run that and basically just zero everything out. And so that way there's a number. So you still get a W-2 with $10,000. Basically, it's like you're reinvesting in your company. You're not taking out of the cash.
So it's something we could do one time at the end of the year.
Yeah. I wouldn't suggest it because sometimes it can be a lot. The taxes can be over. I wouldn't do it all at one. If we're doing the election towards the end of the year, we decide end of the year, then we're going to have to do that. But
So on an
I try to do
ongoing
everyone
thing, then
quarterly.
I get a
set it
paycheck
up.
every month.
Every month,
She
okay.
gets a paycheck
Through
every month.
ADP or something like that. Okay.
Yeah.
Okay.
And then she doesn't have to worry about quarterly taxes. She doesn't have to worry about doing the electronic payment system, 941s, 940s. There's all these
Right.
other things
I
that
see.
go into it.
Okay.
So I wouldn't suggest you doing it on your own because that could be.
And do they
pain.
do direct deposit?
Yep.
Yeah,
Okay,
they do
good.
direct deposit.
All right, good.
Yeah, and usually if I'm running the end of year one, I'll tell it to do it manual check, and I'll play with the taxes. And some people will be like, I don't want the check, just put it all to federal income tax. So I'll do that. We can play around with the payroll, right? And just kind of decide what we want to do with it at the year end. So it's not something it's surprisingly, I'm the busiest in December. Maybe not busiest, but I'm really busy in December just because I'm trying to figure out who's going to move to S-corp, who's, tax consequences, what things I'm trying to meet with everybody. It's always a crazy time. Anyways, so I kind of said all that, disadvantages of S-corps.
Quick question.
Go ahead.
It seems like you are going to keep going through the comparison.
Yes.
But, okay.
Yeah. Well, and you know what? I realized on the where it says C-corps, I put disadvantage of S-corp, I meant C-corp. So you can just cross that out. On where I have C-corps. I was going to say that the disadvantage of the C-corps, it's taxed on its own. So that's like a whole other return, and it's taxed between 15 and 35%. And it's filed on its own as 1120, and if you take money out of it, it's double taxed as dividends. So you're not only are paying taxes on the net income, but you're also paying taxes on your dividends. Most CPAs would not recommend being a C-corp unless you really truly have to. So I wouldn't think that would be the way to go. Go ahead.
Is it an easy segue from S to C?
Yes.
And is it an easy segue from C to S?
It's an easy segue from C to S, a lot harder from S to C.
Okay.
Yeah, because somebody wanted me to do that, and I was like, it has to be in the year before, like, there's all these specific rules. You can go 3 years back and be an S-corp, but for some reason, to, like, revocate the S-corp, it's a lot harder to change that to C-corp. Yeah, it's a lot harder. I wouldn't suggest it, though. So if you plan to have investors, you may want to hold off on being an S-corp completely, if that's obviously what you want to do.
Like, how many of us are here? Investors.
I do have a lot of clients that have investors, and so they do hold off on, and there'll be partnerships with other, and they'll hold off and wait to see what the investors want to do, because it's a lot harder from an S-corp to C-corp, and it's a lot easier from partnership to C-corp, or anything else from a C-corp. So
it's a good goal. Like, I'll have investors.
Right?
I'm just going to sign myself up for that.
It's a lot of like app people and technology people that usually have a lot of investor funds, or manufacturer, like specifically, manufacturing people that t-shirts and shirts and things like that. So, but anyways, or they'll do a round of investments opportunity. Claire's not here today because she knows all about that, and she's a writer also, but her boyfriend is just investing right now all the time. But anyways, man, she's gonna be my other person helper. Anyways, so let's move on. Does anyone else have any questions about entities? Because I could go on and on about that. I'll move on to expenses and other forgotten deductions.
AKA the real reasons to be an
yeah. So some of these are pretty self-explanatory, like subscriptions. They could be simple as writers' magazines to newsletters to small little all your subscription fees that you pay out, which can add up. They're very small in amount, but they can add up a lot later. I just don't want anyone to forget that, right? Those little things. Agent fees, websites, cell phone. Always have a percentage of your cell phone. Like it just has to be reasonable. I mean, I probably use my phone 80% for business, and that's totally reasonable because that's on my website. My cell phone is everywhere. Everyone texts me all the time. So I would probably say that. So if you feel like that's the majority of what you're using most of the time, definitely don't forget the cell phone, because that might not be going through your business account, and that might be going through your personal. I did put a note on outsourcing, because I know a lot of you, I know some of the writers outsource to like editors or other random people, and just for certain little things. I would always say, before you even cut a check, please get a W-9, because that's probably my biggest pet peeve in January, is trying to get all these W-9s from everyone so I can 1099. And you should always 1099 everybody. Basically, the rule is, if you want to give someone money, you make them give you a W-9 first.
Even under 600?
Even under 600, because if you plan to write checks for the rest of the year for them, it doesn't matter what amount it is, you always have your W-9 on hand, their W-9 on hand, in case it does go over $600 in the year. So I always just try to say, I'm going to write a check, I need your W-9. You want some money, and you'll be surprised, that's when you get it. But if January, they've already gotten their money, I'm like, I need your W-9, I need 1099 you. No response. So like, great. So I always try to tell everyone, before you even write a check, just tell them, I can't write a check. My CPA told me I need your W-9. So that would be the one thing I have to say about that. And so we can make sure to deduct that deduction. Now, on every single return, sole prop, S-corp, corporation, the one question that's new, fairly new the last few years, is, did you pay anyone that could require 1099? And you say yes or no. And if you put yes, okay, did you file your 1099s? And you put no, you'll get a letter saying you may have a penalty, that kind of thing. So you want to make sure if there's a number in contract labor, if there's a number in rent, those are like red flags that you may have needed to file 1099s. Now the IRS may or may not ever come around, so they're short-handed right now, but if they were smart enough, they would really go around and say, who has contract labor in there? Do we need to audit them? Because they didn't do 1099s, and 1099s have penalty. The longer by month, like each month that you pass by, the more additional penalty it is for not filing 1099s. So I would always say file 1099s for sure. Business insurance. Okay, the next one is research expenses. I'm talking about CDs, videos, tickets to plays, movies for script research. Writers, I wrote that writers have to keep up with trends in their profession. So there could be personal. So don't make your whole life business, right? So make sure there's some personal in there. But the whole idea is that it's research, and research is important as a writer. So just make sure you get to deduct those deductions, everything that you're doing research for, and make sure you call it that. You're calling it research. Those are all deductions that you need to make sure to take. But like I said, make sure you leave some for personal, right? If you're going to go on a date and you want to go see a play, make sure that you leave some of that part for personal. It's not all business.
Or quickly write a book on dating.
Right.
And then use that.
That's true. You could do that too. Just as long as there's just a tiny bit of personal there.
Travel too.
Well, I'm getting there.
Oh, okay.
Okay. Meals and entertainment. The one thing I wanted to say about this, because everything, meals and entertainment are 50%. I'm talking about when you go and you take someone for dinner, or me and Jackie go have coffee. Those are all 50% deductible. Now, if you have an editor or someone coming inside your office, your home office, whatever, and you're bringing in food to eat to work, that's 100% deductible. Okay, so everybody forgets that deduction. So that, if you have an employee that works for you and you're bringing in food to your office so they can continue to work, 100% deductible.
Is that with any of these structures?
Yes, with all of them.
And how do people distinguish for you? They put in a line item on there?
Meals in office. Sometimes I'll go through the list of meals and entertainment and I can kind of tell. And I usually will send a spreadsheet back and say, was any of this inside your office? Like if I know they have employees. And so they'll kind of like highlight to me, oh yeah, I think some of these. Or sometimes I know that happens all the time and they call in orders all the time. If I'm not doing the bookkeeping and they're doing their own bookkeeping, I usually have them tell me like a percentage of how often. I kind of figure it out from there. So it really just depends if you're doing it a lot. Like I would do it with my employees. I would have lunch delivered every day during tax season. So sometimes not during tax season, but yeah, I would for sure have lunch delivered every day during tax season. And I knew during tax season, those months were all 100% deductible. So, when there's a busy time and you have people come in your office to literally work and eat, that's important.
Does this count if you're the one employee of your company? So you count as an employee?
No, it has to be someone else with you. It can't be just you by yourself eating lunch at your lunch table.
Not your pretend friends either, Matt.
If you're an
No.
employee of your...
Yeah.
No. It has to be you and someone else.
Got it.
Either an outsourced person or an employee or another writer, editor, whatever. And it has to be work related and in-house. Like if you'll decide to go to Home Slice to go work on something, 50%. It's about bringing something in for your convenience. I don't care if you're working at Home Slice for something. That's still 50%. That's fun to the IRS. But if you're bringing something in the office to specifically work on, then it's 100%. Does that make sense?
Or whenever you're working.
Right.
Yeah, got it.
Inside, right. The other thing is another missed deduction is sales tax deductions. Like if you're going to buy a boat or something big, a car, you add it to you have like a table amount for sales tax, for Texas sales tax. They were going to get rid of it. The IRS was, but they didn't get rid of it. So that's still, for some reason, when I look at someone's return that they did on their own, that's like the number one thing I always see missed on an itemized deduction. That's if you own a house. If you own a house, then you get to take itemized deductions. Not the table amount, for some reason, people forget or they bypass it on TurboTax, or I don't know how they miss that. But for some reason, the sales tax deduction is never there. And it's like a table amount plus if you buy something big. So you get to the table amount of sales tax. And it's basically your AGI times 8.25% or whatever. They have like a table. And plus, if you paid for a car, that whatever sales tax you paid on that, big purchases. I actually have clients that will add all their sales tax all year long. And I'm telling you, it's going to be very similar or higher on the table amount. Usually it's higher on the table amount, but anyways.
What do you
Go
mean by
ahead.
the table amount?
They have like a table amount on, like if you go and you answer questions
Oh, for the,
on the tax return, there's a table amount. You put Texas and it'll ask you what's the sales tax in Texas, and it literally will calculate it for you. It's very easy.
and this sales tax is also for all of the structures.
Yes, this is for a personal return. But this is for personal return. Sorry, I'm going back and forth. This is like on your personal itemized deduction list. Yeah, that's an important deduction on your itemized. And speaking of itemized deductions, the other one, if you do itemized deductions on your personal return, charitable deductions, like the non-cash ones, I always tell everyone to take a picture of the stuff that you're sending to Goodwill, please. Just take a picture. Like just dump it in a pile and take a picture of it real quick, just so there's evidence that you gave it to Goodwill. My husband's terrible about taking pictures, and he just takes it all the time. He's over there listening.
Snickering.
Yeah, snickering. He's laughing. But donationcalculator.com is a great little spreadsheet I use that kind of it'll say like good, fair, great condition, and it'll have like $1, $2, $3 kind of situation. And surprisingly, it adds up. Like, I can't tell you, some people have like huge amounts, and we just detail it. If it's like a huge amount, we detail it, and the IRS is happy with it as long as it's detailed enough. What else was I going to talk about from there? Oh, okay. Going back to also on your return, if you are a sole prop, you can take self-employed health insurance, which includes your children too, if you're on a self-employed insurance plan. So you can add your children onto that, and that's a deduction. Now, if you have, the only way that works though is if your spouse or someone else doesn't have the ability to put you on his. So if you're a single person and you have a self-employed insurance under yourself, and you, let's say a child or whatever is underneath you, or your husband, that's all deductible on that side, but you have no opportunities to get any health insurance anywhere else. Does that make sense? And it's not an itemized deduction, by the way. It's literally a deduction against your AGI. So it definitely helps. Now, the refinancing points, that's if you refinance your house. That's a whole other conversation. But sometimes people forget about that. And I'm like, what? You refinance your house? I need that closing. And so sometimes you can find deductions from there. And that's itemized deduction too. So you have to be careful with that one. Section 179 and bonus depreciation, this is under the business. Any business structure, sole prop, S-corp, C-corp, they're phasing out the schedule 179. You can basically write off assets all in one swoop, so up to $500,000. Now that was supposed to expire. They extended it all the way to 2015. At the end of this year, we'll find out, either the end of this year or early January, depending on when Congress decides to meet, we'll decide if it's going to be extended all the way to 2016, which it usually is. It was supposed to expire like 2012 or something. They keep extending it and extending it and extending it because a lot of small businesses really need it. And it's up to like $500,000. So basically, we'd like to find out at the end of the year, because if you need any big purchases, you want to buy them business-wise, you want to buy them all at the end of the year. Computers, laptops, things like that. Use Section 179, the whole thing all at once, write it off in that same year if you need it. And there's also bonus depreciation. That one hasn't phased out yet. That one's good for this year. But the Section 129 is the whole thing. It's the whole shebang, whereas bonus depreciation could be 50% deductions, not the whole amount. I want to talk about automobile expenses, because it's probably the most common and largest deductions for writers. It can be taken two ways, and I think probably everybody knows this, right? Repeat myself. There's a standard mileage allowance. In 2016, it's 54 cents. You don't really need receipts, you guys. Pretty much that goes for everything. You don't really need receipts. It's on your bank statement. There's something called the Cohen rule. I'm being recorded, so now I'm like, oh, this is just something like that we say. It's the Cohen rule is really, if it's a reasonable business deduction, you can deduct it, right? So a long time ago, someone didn't have receipts, went to the tax court, basically said, I don't have receipts. He proved that those are reasonable expenses for the industry he has. And they said, okay, and they call it the Cohen rule. I have no idea why, I can't remember, probably the lawyer or something. And now, if you don't have a receipt, it's not the end of the world. So if an auditor ever tells you, you need a receipt, you'd be like, Cohen rule, I don't really need a receipt. But usually the bank statement's good enough. What I always tell everyone is it's like a big purchase, or it's like something that's like H-E-B, Walmart, things that you could buy personal items with that you really can't tell what it's for. I would keep those receipts because it's just there. You could buy too much different stuff. Like if you went to Office Depot, I don't really care about the receipt. There's only one thing you can buy, and that's office supplies. Usually it's like
But we should use our debit card and not pay cash. is what you're
Yes.
saying.
Oh,
Okay.
please don't use cash ever.
Okay. really?
Saying right now,
Oh.
do not do cash. Use cash, please. Don't do that. No, always use your card.
Oh.
Always use your business bank account. Don't do that. Who uses cash?
Sorry.
What are you talking about right now? I'm just kidding.
Like dollars, like
Yeah.
the
Yeah. But,
What's that?
They strongly
Yeah.
prefer cash in Europe.
yeah.
It's like
Well,
Well, that's different. Okay, so I do have some travelers. I'm going to talk about traveling in a second.
Yeah. And-
Travelers are different.
Yeah, and the
I
fact
would
that
take
most our
out.
credit cards don't work in Europe as well.
Right. I would take out ATM it and write things that you bought
I see.
with it on just a sheet of paper. I usually have my travelers send me an email, like when they take out the cash. I took out an ATM. I'll let you know what I used it for, and then they email me like a list of things that you used it for, and I'm like, okay, that's fine. That works. That's a receipt for me. But in the United States, within this area, don't use, because usually they're smaller items, and most of the time it's like meals and entertainment and taxis and stuff like that out of the country. But for everything else, it's like that. Am I running low on time? I could keep talking forever. Okay, good. So, business miles, that's what I was talking about. Don't forget, trip to pick up supplies, driving to libraries, bookstores. People forget all those. Yeah, the driving here, things like that. People forget that. People want you to use a calendar. IRS really likes you to use a calendar. That's proof that you went to different places. But if you can help it, try to put little trips to places on your calendar.
I keep a spreadsheet and I use MapQuest to define the miles. That's good enough.
Yes,
right?
that's
reasonable
totally. I always tell everyone,
Okay.
Google
Because
Maps.
then I don't have to do my odometer, which I never can remember to do.
I know, I never do it either.
I'd like to share a
Go ahead.
resource that
Go ahead.
because I always have the best intentions and you're recording it. But Mile IQ, and there's other apps, but all you have to do is swipe left for business and then categorize the deduction. It tells you where you've been. I'll look at that even 3 days later. I'll be like, where was I?
Yeah.
Oh yeah,
That's
I
a
like
good
to-
one.
So you
Mile
want
IQ
your-
is
just
a great one
automate
too.
it, because I didn't do it for 7 years.
Yes, that's a great one. And then at the end of the year, it's like all there. It's all inside there. Yeah, if you can be, remember to do that and to use that, that would be great. And like I said, remember to do that. Remember to do that, like when you go to the trips to the store and things like that. Trips to meet, y'all are going to go have discussions after this. Remember to do that then. That kind of thing. But yeah, Mile IQs, I forgot about that one. That one's really good. So the other method, though, other than the standard mileage, is actual expenses, like your actual oil changes and your gas and things like that. I don't think I've ever seen that being higher than mileage. Very occasionally, it'd have to be something really huge for it to be higher than mileage. So I would definitely suggest using mileage. But if you want to keep track of the actual expenses, you can. Now, the other thing I want to say about that is that once you choose your car as a sole prop, I'm talking about sole prop, once you choose your car and you put mileage on it, and you say, I want to use the standard mileage, you can never do anything else. You cannot use actual expenses. Until you sell that car and get another car, then you can decide mileage or actual. Like it's a one-time thing, you can't decide anything else.
And you were saying earlier, if we buy a car, we can deduct the sales tax, but only if we own a house.
Well, it's because that's an itemized deduction on a sales
Okay.
tax.
All right.
So that's a whole other conversation. The other thing is
So short of owning a house, there's no
Yeah.
other deductions on the actual buying of the car.
no.
Okay.
Well, unless you decide to use actual, you can section 179 up to a certain amount, but it's not the whole amount of a car.
Okay.
And also there's personal use with it, so you have to think about percentages. So
But again, you'd be stuck with that for the rest of that life of that car.
then you're stuck with it for the rest of that car.
Okay.
Go ahead.
Do you have to use the same car all the time? Or,
No, you can have multiple cars for business use. You just have to remember what the mileage is on each one, and you can use actual for one, mileage for another one, depending on what you use for it. Yeah, it can get confusing. And you got to remember, like my tax software remembers all my different clients and what they used, so it tells me that person, unless I add a new vehicle, then I get to choose. So it might be the same way on other tax softwares, I'm sure. So it's been a long time since I've used like a normal tax software. probably 10 years. Let's see. Oh, the other thing I wanted to talk about was home office expense. Now, this is another thing that you could do as an S-corp, and people forget about that too, because you definitely can use home office expenses as a sole prop, but you can also remember to have part of that. That's your only office as an S-corp. Kind of works the same way. It's a little bit modified depending on what's going on with your situation as an S-corp, but as a sole prop, you have basically your Schedule C, and you have two options for home office expenses. It's simplified. You multiply the square footage by $5, and the max is $1,500. Or you can use actual, which would include the mortgage insurance, the property taxes, the utilities, that kind of thing. Like if you had some kind of repairs, if you pay rent, that's a percentage of what your square footage divided by the square footage of the office divided by the square footage of the house or the area, the whole house. The issue with that is that you have to try to have an exclusive area for business. So the IRS is pretty picky about it, but they're not going to go through your house and say, wait, you use this. But they don't like it when you use your couch. They don't want you to use your couch where you also sit and watch TV. They like to have an exclusive area for business specifically. So usually a little office or an area, and that works just fine too. But you know, it's such a small percentage. One of the things that the IRS auditor told me, it's like, if it's something small, we're not going to go audit for something small. We want the big money, right? They want to see something big. So I don't think that's really that big of a deal. And I always tell everyone, always calculate both. I always calculate both, either the simplified or the actual, to see which one's higher. You may or may not want to, but sometimes it makes a difference on that side. So I would try to do it if you can. Now this is the fun part. The travel expenses, because I'm hoping as writers you all get to travel. So if you spend all of your time on business, it's 100% deductible, except meals and entertainment, which I talked about, which is 50%. Now, talking about this, that first slide in the beginning is within the United States. So we're going to talk about within the United States. If you spend more than half your time within the United States on a business trip, then 100% of your expenses are deductible if it's less than 7 days. Okay, so if you're spending more than half the time, your transportation, I'm talking about air fees, I'm talking about baggage fees, things like that. Now the lodging and the meals and entertainment, those are going to only be the days that you're working. So like if you know you're going to have to work on certain days, those days that you're lodging, the hotel, that's going to be deductible. But the days that you're just playing, not deductible. That makes sense. But even the transportation costs, the whole thing, the air flight, everything, that's 100% deductible. So I kind of have it written out for y'all there, so it's a little bit clearer. Business days must outnumber personal days. Travel outside of the United States is always a bit more flexible. If you travel outside of the U.S. for no more than 7 days, you can deduct 100% of your airfare or transportation costs, such as trains, etc., as long as you spend part of the time on business. That I'm talking about, this is less than 7 days. Okay, so and 7 days means consecutive, so you can't just like go to a different country and then call it different. It has to be 7 consecutive days. As for the lodging and meals and other expenses, only on the days that you're working. So for more than 7 days outside of the United States, if you're planning to spend 10 days or 30 days, the magic number is 75%. So if you spend more than 75% of your time on business at your foreign destination, then you can deduct 100% of your airfare or other transportation expenses. A lot of people don't know this. This comes from my continuing education, because I take all these education classes that tell me all these little tricks. And because if you look at some of these, you can't really find this, but you can find this detail in the IRS code. Plus any living expenses while you're in business or any other business related expense while you're working, right? So still meals and entertainment are not deductible on the days that you're not working, but all the airfare and things like that are 100% deductible. Sorry.
Are you familiar with the 330-day rule for traveling?
Yes. Mm-hmm.
I have a question about that. When I was looking at it, because I spend most of my time outside the U.S.
Okay.
And
so this is important to you.
It is important, but not yet 300, that full time, which I understand has to be, not even a minute short of that 330
Mm-hmm.
days. But when I was looking at it, it seemed to indicate that your income has to be earned from outside the United States.
Yes.
So I'm writing primarily, say, for Amazon. That's a
Right.
U.S. company paying me. So I was like, I guess I can't exploit that rule then.
No, not.
Would completely excuse me from all taxes. Or
Yeah,
personal
you're
income
still
tax.
going to have to pay. Yeah,
Because of Amazon.
Exactly.
Okay.
Yeah. Sorry.
That's
You
what
failed.
I thought. I'd just see if it was Amazon. I know, damn you.
Amazon.
But why can't they incorporate in Ireland or something like Apple does? Apple's not
You
a...
just put it all on Amazon UK.
Right,
and
right.
Put it on the US.
Tell
Yeah.
them I need a check from Amazon UK.
Yeah.
I'm just kidding. So if this trip is more than 7 days, and you spend 50 to 75% on work, I have it listed there, then you can deduct only the business percentage of your transportation under the cost. So if you know half the time or a little bit over half the time you're going to be working, then you can only do that percentage on transportations and other costs. And of course, you can still, on the days that are business related, you can still use the meals and entertainment and the business expenses. Go ahead.
What if it's like a research trip?
Yeah.
So yeah, those are a little weird. So really what I would do is I would get the number of days of business days and number of personal days and figure it out that way.
So I'll make a research trip to England, which I'm going to do this year. I'll be there for about 2 weeks, and I consider all of it work.
Yeah.
It's not that I don't love my work, but it's all work.
So are
right?
you
I'm
doing
working, I'm
anything
doing
personal at
research.
all?
No, everything
Then
I do is
it would
sort
be
of
all-
aimed at. I mean, I write novels, so
Yeah, I would.
looking at anything that I look
I
at
would
is
use
risk
that.
for my mill.
Now, if
No,
you plan to like meet with your family somewhere
no,
and
Going by
that's
myself,
different, then I wouldn't worry.
Yeah, it's all oriented towards. The
I wouldn't worry about that then. It sounds completely
Like
business,
exact
100%.
of it.
Right. Mm-hmm.
And just one quick question. I mean,
Go ahead.
travel seems to imply that you have a rent and you're paying for a place here.
Yes.
When I go, I just go. And I'm
I
living
see.
there.
Well, that's different. That's a little different.
Okay, so none of this. Okay, we'll have to talk
It's-
separately.
Yeah, we're gonna have to talk separately.
Okay.
So obviously,
Wow.
we're talking about
'Cause
traveling.
that's not travel.
and you're
That's
not,
just me living there.
Yeah, that's a little different.
Okay.
That's
All right,
a little
we'll work it
different.
out later.
Go ahead.
One more question, and it probably isn't going to be yes. I have to put my dog in the kennel when I go. Is that deductible?
Okay, so no.
No, I knew it wouldn't be. But
So
I want
someone's
to-
gonna have to care for the dog regardless.
Okay.
So it's a little bit harder, whether it be personal or business. So unfortunately, sorry.
Oh,
Even
good
if the
point.
dog's your writing partner?
You can take the dog with you, but the food that they're gonna be eating it's gonna be personal.
Yeah, no, she's good. She's good riding partner.
Yeah, no.
Hours all day.
So the other thing I added was conventions. Oh, less than 51% on business. You cannot deduct any of your costs. So try to do at least more than half the time. So more than half the time on business as much as possible. Otherwise, you can't deduct any of the costs per the rule. So conventions, if you go to a convention, 100% expense. I used to work for like a big firm, and the two CPAs would take their whole families and go to like a CPA. We need 40 hours of CPE every year, and so they go to like this week-long trip to Las Vegas, and they take their family, and that whole trip would be deductible because they would spend the whole week doing convention from 7 to 3, and then they do whatever they wanted at night. So, and they would all meet up because they were partners and work-related stuff and kind of work a little bit, that kind of thing. So conventions, 100% expense. You cannot deduct the family expense. So if you're also feeding your family, that's not deductible. Just the times that you're meeting with other people, if that makes sense. I did want to talk about, I talked about this a little bit already, about retirement deductions. About the SEP IRA, the max contribution is 25% of self-employed wages, or W-2 if you're an S-corp or C-corp, or $53,000, whichever is lesser, right? So that's kind of where it's important with the S-corp when we talked about the S-corp, and that is on your personal return. So as not an itemized deduction, but a deduction from your AGI. So it's always nice to, I kind of put a little, if you put away $5K each year for 20 years, when annual investment of 8%, your 100K is $247,000 in 20 years, about $194,000 if you had a 25% tax bracket. So thinking about it that way, if you at least save $5,000 each year, in 20 years, technically, you should have about $240,000, technically. So the great thing about the contribution, the retirement deductions, is that you basically get a small credit. It's not dollar for dollar. So like if you put in $5,500, you're not going to get a $5,500 exact dollar for dollar. It's just going to lower your AGI by that amount. So you're going to save, there's going to be some tax savings there. So I always play around with the numbers as I'm doing people's returns, and I'm like, if you put this much into retirement, and then you can save this much on taxes. So basically, they give you a little bit of money. Now you're going to eventually have to pay taxes on it, right? Eventually, so you have to remember that too. The other thing is, when you're doing that and you're kind of feeling out which one's better for you, the SEP, the IRA. Also remembering when the deadlines are, because like the IRA, you have to fund by April 15th, right? The SEP, if you extend the return, you don't have to fund till October 15th. So sometimes we do both. We'll fund a little bit of the IRA and then we'll fund the SEP because you have some time to put in that money and kind of give you some leeway time to get the funds to fund it. And you still took the deduction for last year's return. So just playing around with things like that and kind of figuring out what maybe is the best. And obviously cash flow is important, so we don't want to have it out. We kind of play around with that. IRA for everybody, $5,500 is a limit under age 50. Anyone 50 or older is $6,500. Also a credit, not a credit, a deduction against your AGI. To qualify for the full deduction though, you have to basically not be eligible to participate in a company retirement plan. So you don't have a W-2 that's allowing you to have, contributed to a plan. If you're eligible, you must have an AGI of 61K or less for single, 98K or less for married. If it's between 61 and 71K for single, or 118,000 for married, there's a partial deduction. So it's not like it's over, right? But there's a partial deduction. And if it's higher, if you make over your AGI is over $98,000 for single and over $118,000 for married, then there's no deduction at all. So that's important things to remember. You may not want to contribute as much. Maybe you want to contribute a different way. Maybe you want to do Roth. There's all these different other things. Oh, and that's what I have last, Roth. So if you expect to make a lower amount of income in 1 year, I always tell people, if you have the cash, put it into a Roth, because there's basically you're paying the taxes in that year and you're locking in that tax rate. So if you have a low tax rate in that year, later on when you take it out, you're not going to have any taxes that you have to pay for it. So you might be in a higher tax bracket later. Now the expectation is that taxes are going to go up. I don't know if that's at this election time that's necessarily going to be the case, not be the case. I don't know. Sometimes the people are weird. They'll do the Roth IRA. They think taxes are lower at the moment and they expect it to go higher. Sometimes they'll wait it out and they'll put it into normal IRA. So it just depends on how you're feeling or what the year looks like for you. I always think, and that's the next one, is employing your children. Except I don't employ my children, they all work for free. I make them work all the time. They constantly work. But you can use it depending on the amount you can avoid income taxes. There's no Social Security tax when you hire a child who's 17 or younger. And you can deduct the salary as a business expense. So that's a huge benefit. And this only works if you are a sole proprietor, by the way. Does not work if you're an S-corp. I put that on there. The extra is if you can convince your child to forego the cash and put into Roth IRA because their tax rates are really low. So if you can convince them to forego it and save it and put it into Roth, that'd be awesome. But I don't know what child would actually agree to that. I'm not sure. I don't know. I'm sure there are some kids that will do that.
First of all, they don't work for free.
Yeah, they do. Well,
No, they have a house over their head.
okay. They don't work for free. They have a house over their head. Go ahead.
It doesn't work for S-corp or C-corp
No,
too?
only a sole prop for that part. Yeah, for the self-employment taxes and everything, the benefits of it, that works. They could do a Roth IRA. You could still have employ your children if you have an S-corp, but it doesn't work as great.
Above is
Yeah,
only for
right. Now the other thing, and I talked about this earlier too, is hobby losses. We don't want anyone to consider that you have a hobby. That is not a hobby. This is an actual business. This is not a hobby. They don't allow deductions as a hobby loss. They don't allow a loss. So basically, if you did have a hobby, the point would be, here's your income, here's your expenses, and basically it's zero. Like you don't claim anything if there's a loss there. So if the intent is to make a living out of writing, you should do most of these items. And I wrote a list. Keep business records, either an accounting program or spreadsheets. Separate your checking account for transactions related to writing. If you can completely just open another bank account, checking account, that would be great. attend classes and conferences to improve your skills, advertise and network, like what you're doing now, vehicle expenses, log of mileage, maybe the mile IQ, like we talked about, obtain any required license insurance, give your business a name. That's kind of important too. You go an LLC, give yourself business a name, then it's like it's an entity on its own. That's the whole idea of it. And of course, chart future projections and plans to turn the activity into a profitable enterprise, assuming there's losses at the moment. So that kind of brings us to my next, that kind of like plays into the next thing I want to talk about, which is organization. To me, adding a business bank account saves so much time organizing at the end of the year. I feel like that's so much easier to kind of go through. I'm not saying that every once in a while you're going to use your business card. Every once in a while you're going to use that business card, but you kind of keep track of those personal expenses, and they're going to be few and far between. But hopefully you just use that business card for business stuff. And obviously if you need money, you transfer your personal account. I always try to tie in the business account with the personal account in the same bank account, but not the hugest fan of federal credit unions. I'm sorry. Because it's not as easy to account for. You can't like download the whole transaction into like a pretty Excel spreadsheet at year end. So if you're going to do something smaller like UFCU or Randolph Brooks Federal Credit Union or something small like that, okay. But if you're going to do that, definitely get accounting software. I was looking at the QuickBooks Self-Employed. It's like $5 a month right now. That's if you're sole prop. Like this is QuickBooks Self-Employed. If you're deciding to do an S-corp, I would definitely do QuickBooks Online, something to a higher nature. They're a little bit more expensive, but you're gonna have a balance sheet and you're gonna need those kind of things and reconciling and things like that. You're gonna need that for an S-corp. But if you're just a Schedule C, QuickBooks Self-Employed will work just fine, and it automatically calculates your estimated payment. Literally, there's a thing on the top that says estimated payments, and as you're making money, you'll have to fill in like if you're married or single, what your W-2 wages are, that kind of thing. But it'll automatically, as you're entering things, it'll automatically tell you what your estimated payment should be. I'm skipping a whole lot of stuff, am I?
No.
Did I skip anything? Okay, I feel like I skipped the estimated payments. I guess I'm getting there. Yeah, that's at the end. Anyways, I haven't looked at this.
Quick question on, you said
Go ahead.
transferring, and I know you can do that with an LLC, but you can't transfer with an S or C-corp, right?
No, with an S-corp you can transfer funds. So I know you're going to be an employee of your own company. So this becomes kind of...
Okay, so S-corp but not C-corp.
So C-corps you can't. Yeah,
Okay.
C-corps you can't transfer back and forth. S-corps, they're called distributions. So when you do transfer money out of your business account to your personal account, there's something called distributions. Now you still kind of have to be careful because there's something called a basis with S-corps. This is where I'm getting a little higher level. Basis is a little bit more complicated, but technically you're just not supposed to go over your basis, like to negative. You're not supposed to go into negative field. Otherwise, then you have to pay taxes. That being said, it can be difficult to do that. And the person that keeps track of your basis technically is your CPA who's doing the S-corp return. So if it goes in the negative, in the red, your CPA is going to say, hey, this is in the red, let's make sure to do this or do that, or most of the CPAs call that due from shareholders until the basis goes up again and you make income. Hardly ever does that happen. Usually we try to pair really well with the payroll versus distributions so that the person is not, one, leaving themselves dry, or two, leaving their business bank account dry. So there's a good even balance between distribution still and payroll. So you're still going to be, obviously it's you're working, that's your money, so there's still going to be some of that. So
So I have a question
Go
about
ahead.
hobby loss.
Yeah.
If you keep good business records
Yes.
and do like a separate entity, can you run a loss indefinitely, or does the IRS ever catch you?
If you have losses on a Schedule C, depending on what else is going on.
Yeah.
So a lot of times, it's not really red flagged, and I'm saying this, I can't know this for 100% sure, but if there's losses and the spouse makes money, that might not be flagged as much as if there's 3 dependents and there's a loss and they're not making that much money. They're gonna be like, how are these people feeding their children? What's happening here?
But to the business, let's say you have a couple of sources of income. Your writing business is
Right.
running a loss compared to your other sources of income.
Right.
Can you just write? Can you keep writing off your
They
trips
don't-
to England and such?
No, they don't like seeing like 5 years, like
Okay.
3 to 5 years of losses. I think that would red flag it tremendously. Like if I see a client having continuous losses, I'm going to say, well, let's do something else because don't want to do an audit. So, so that's, I wouldn't suggest that, regardless if you have other stuff going on for that long. And the other thing is like, if you're a farmer, you can definitely have losses forever. They don't seem to bother farmers because they know farmers are going to have losses. But with an artistic profession, different story. Definitely may get red flagged.
Maybe you can prove that you're trying to sell your work and you're just unable.
Yeah, I mean, it's
So like rejection letters from
definitely,
editors, I always thought
definitely.
that was good for one. Okay.
It's
Yeah.
if it's an actual thing that you're working on and you can prove it, then I think they
Done
would be
all
fine.
this stuff and you're getting rejection
Right.
letters and you're not getting the
That's
stuff.
why those things are, as long as you're doing those things,
Oh yeah.
they're going to be like, okay, you're not a hobby. This is an actual profession. I don't know if I would go as far as 5 years. It would have to be like you're actively seeking work and it's still having losses, then I'm okay with it. But if it's like you're just kind of like bruising around and just, having fun and things like that, there are going to be losses for sure. And sometimes like there's going to be one. What happens with a lot of writers is that they'll have 1 year of income and then the next year's a loss. And then the next year's a loss, and then the next year's a loss, and then there's a bunch of income, and so it's like it varies, and that's okay too. It's when it's all consecutive, and it continues to be, and there's no profitability. That's where it can get red flaggy. That makes sense. Organization. So we're talking about getting organized. So I would definitely, and so when I was talking about QuickBooks, hopefully everybody's familiar with QuickBooks Online because it's really easy to download your transactions, tell it what it is. Record them that way. It's really, really easy. But that kind of brings me to estimated payments because QuickBooks Self-Employed has a little feature on the top that says self-employed on the top. QuickBooks Self-Employed has a little estimate payments and it'll calculate your estimated payments on that. That being said, I have millionaires that refuse to do estimated payments. The quarterly estimated payment penalty is so low, they would rather keep their money and not worry about it. So it's kind of a little bit, every tax return prints out estimated vouchers. And so it's kind of your decision which one to make. I always tell anyone, if you're going to make at least the fourth one in January. And I kind of have that written out there too. I wrote out my whole thought process there because I wanted you all to read exactly what it might save. The guide, I put the link to the guide to the ES payments if you really want to know. But basically, if you look at your AGI in 2015, because it's based on last year's return, and then you multiply 4,000 times the number of exemptions, subtract above from AGI the itemized deductions or the standard deduction, and the exemptions, and then you figure tax using the 2015 tax schedule, which is on that link. You multiply that tax by 90%. If it's more than $1,000, you're required to pay estimated taxes. You divide by 4, and that would be your quarterly estimated taxes payments that you would need to make. You're required to make. Again, a lot of people. The other thing is, especially with writing profession, if you get an advance, you may be inclined to pay an estimated payment, but then you don't know what money might come in later on. Hopefully, that's not an issue. But that would be my worry. So I always tell everyone, try to save some money on the side for taxes if you can, without having to need it necessarily, but without giving to the IRS, because you don't want to be in the position where you give it to the IRS, but then you kind of need it back. I need it back, IRS, and they're not going to give it to you back. It's not going to happen. So that's my one issue with it. Go ahead.
The penalty, is it flat or percentage?
It's not flat, it's a percentage, but it's based on how much you make. And I didn't put the penalty, but it's out of everything else, it's probably one of the lowest penalties.
That's fine.
And you can annualize it. I think so. You must pay 100% of last year's tax liability or 90% of this year's tax liability, or you will owe an underpayment penalty. If you have AGI for 2015 that was more than 150K, you have to pay 110% of your 2016 tax liability. to be protected from that underpayment penalty. If you, and this is what I said, if you receive in advance, estimating those expenses and knowing what the net result will be at year end, typically I try to tell everyone to save 20% for taxes. If there's uncertainty about next year's checks for the rest of the year, I would hold off on sending any to the IRS unless you know what you're expecting. And then I always tell everyone, if you're going to make an estimated payment, do only one. Do one at January 15th, because you can erase at least that penalty for the fourth quarter, and it's the next year, so you kind of know what last year looked like. And you still owe a penalty for the earlier quarters if you did not send any estimated payments back then, but you kind of like make it less. Also, if your income arrived after August 31st, that's the other thing, you can kind of reduce your penalties if you do like a 2210, which is like a form basically analyzing your income and saying, this is really when I got my income. So I couldn't have paid you earlier in the year because I really got it at the end of the year. So the penalty kind of gets lowered. So that's kind of also, bless you, a good way to reduce that penalty. It's a really low penalty though, but anyways, I live by the notion, I think a lot of CPAs live by the notion that I would rather owe the IRS than have them keep my money. So I know some people like to get refunds and such. I'm like, I cringe. They're like, yeah, I'm getting a refund. I'm like, oh, they kept that much money in there. But I mean, some people are not okay with money. They would rather give it to someone else and then get it back, which I understand. And I think that is it. That is all